Hello everyone to the behavioral finance video. So, what are we going to talk about behavioral finance? First, we need to understand the meaning thereof. It is a study that influences the psychology of behavior of financial practitioner and the subsequent effect on the markets. Behavioral finance is an interest because it helps explain why and how markets might be inefficient, as the case might be. It needs to be efficient and it needs to be inefficient. Why it becomes inefficient? Why? What behaviors will enable it to become much more efficient thereby? So yes, we are talking about the practitioner's psychology, as in behavioral finances, where investment should be done, where the money should flow. This is what we need to understand. Most people know that emotion affects investment decision. Definitely yes. People in the industry commonly talk about the role greed and fear play in driving the stock markets. Behavioral finance extends this analysis to the role of biasness in decision making, such as the use of simple rules of thumb for making complex investment. Behavioral finances takes the insights of the psychological researchers and applies them to the financial decision then and there. The nature of behavioral finance. Behavioral finance studies the psychology of financial decision making. It makes the understanding of the investment decision there. It is the study of investors' psychology. It is analytical in nature, and that is what we would like to go across with it. Scope identifies the personality. And whose personality we're talking about? The investor's personality. Helps to identify the risk, provide explanation to various corporate activities, enhance the skill set to investment advisors to understand the market anomalies as what are being present. Now, this is the scope of behavioral finance. The objective remains to study the emerging issues, what is happening in the financial market, to understand the psychology of the investor. With what psyche does an investor put in money in the market, in the stock, in investment, in any decision per se, to study the changes in the trends in investment per se. To study the investment decision, develop the strategy of financial decision, study the scope of investment decision out and every time that you are talking out there. So this is what we should be talking around. Psychology. Psychology is concerned with every aspects of behavior and with every thought, feeling, motivation underlying that behavior. Psychology is defined as a scientific study of human behavior with the object of understanding why living being behave in a particular fashion per se. Isn't that psychology is all about it? So, scope of psychology: social psychology, behavioral psychology, applied psychology, and educational psychology thereby. Nature of psychology. Psychology is a science. Psychology is a social science. It's a community feeling, the way community behaves. Psychology is a positive science. Probably you can make an inference out of certain situation all every time, certain behaviors every time. Psychology is an applied science. Probably you can manipulate their behaviors by applying certain situation or by implying particular characteristic within that environment, installing them. So yes, psychology is a science, social science, positive science, and an applied science. The psychology of the financial market, is it a market psychology? Is it the boom and cycles? Is it the psychology of the investors and the psychology of a rational man? And how do we come across with it? And that is it, what we are talking about it. The market psychology of an investor, the psychology of the rational man, the booms and the cycle thereby. Yes, we are talking about the behavioral approach. Yes, we're talking about the cognitive approach, the psychoanalytical approach, humanistic approach, and eclectic approach, as the case might be. It all encompasses the investor's behavior. Behavioral finance market strategy is all about market timing. We are going to time the market, and that is when to put in the money, when not to put in, or when to withdraw the money. Is timing of the market. It isn't the buy and the hold strategy. Technical analysis as a tool. Behavioral indicators as on when on basis. Modern investment theory says that at all times market prices equal fundamental value and that the assets in the cross sectional reflects the relative exposures to systematic non-diversifiable risk. Despite decades of data analysis, empirical supports for this theory remains absolutely thin. What are we looking at it? The prospect theory? Yes, the theory states that the people that make decision, the people who are in the know of the things, are making decision based on the potential values of losses or probably the potential values of the gains than the final outcome. So it's the probability factor that plays in. It's that the people evaluate these losses and gains using certain heuristic. The foundation of this prospect theory is that the investors are much more distressed by prospective losses and that they are happy about the prospective gains then and there. That is what we want to go across with it. Loss aversion theories in economic and probably even in decision theories. Loss aversion refers to the people tendency to strongly prefer avoiding losses to acquire gains. Most studies suggest that the losses are twice as powerful psychologically as gains are. This leads to the risk aversion when people evaluate an outcome comprising of similar gains, similar losses, since people prefer avoiding losses to making gains as on when on basis. Isn't that the thing that we need to address? Mental accounting theory says it is all about framing. It is about frame of references. That means the way a person subjectively frames a transaction in their mind will determine the utility that they receive or the what they expect altogether. It is the tendency of the brain to create shortcuts with how it is perceived, the information, and ending with the outcome that is difficult to view in any other ways. The result of these mental accounting are that of influence decision in a particularly expected fashion. So that is what mental accounting is all about. It is a accounting theory framing by which a person subjectively frames a transaction. It is a tendency where brain creates shortcuts with how it is perceiving information and ending with the outcome. Investor disposition effect. The disposition effect is an anomaly discovered in the behavioral finances. It relates to the tendency of the investor to sell shares whose prices have increased while keeping the assets that have dropped in value, as the case might be. Investors are less willing to recognize losses when they would be forced to do so if they sold assets which had fallen in value but are more willing to recognize gains. This is an irrational behavior as the future performance of equity is absolutely not related to the purchase price. So that is what need to understand as far as investors things are concerned. So investors are less willing to recognize losses but are more willing to recognize gain, as in the greed plays much more effect than the fear. With this, I come to an end of this video. Thank you for watching the video.